All right, welcome. Today, we are putting on our detective hats and diving deep into the curious case of a single stock, FEMY. This thing has been on an absolutely wild ride, and its charts are just packed with conflicting clues. So our mission, if you will, is to decode these signals and figure out what the market is really trying to tell us. Let's start by examining the scene. So first things first, just look at this price action. Over the last 3 months, FEMY has been the literal definition of a roller coaster. I mean, it hit a gut-wrenching low of just under 31 cents, but before that, it had rocketed all the way up to a high of over $1. And more recently, we saw it drop in late August and then just explode upwards at the beginning of October. This is exactly the kind of volatility that makes us stop and say, okay, what is going on here? And all that crazy price action leaves us with a central mystery, right? Is this huge, sudden spike just a classic short-lived pump that's about to fall apart? Or are we actually witnessing the very beginning of a sustained, legitimate rally? To figure that out, we've got to dig into the technical evidence. Every investigation starts with the fundamentals. Before we get into all the complex forensic indicators, you have to follow the money. And in the world of trading, that means looking at two basic things: price and volume. They tell us exactly what happened and, more importantly, just how many people were involved in making it happen. Let's talk about the sheer scale here for a second. On October 3rd, the day the price just took off, over 26 million shares of FEMY changed hands. Now, this isn't a few people whispering in a corner. This is like a stadium full of traders all shouting at once. A massive volume spike like this on a big update is an absolutely critical piece of evidence. So, what does a clue like that actually mean? Well, when you see high volume combined with a big price surge, it suggests conviction. It's a signal that the move has broad participation and some real interest behind it. You know, it's the difference between one person trying to push a car and a whole crowd lifting it up together. It tells us this recent price jump has some serious muscle. Now, if we look back over the last 3 months, we can also see where most of the action has been concentrated. The data shows that by far the most shares were traded in that 36 to 41 cent range. In technical speak, this is called the point of control. You can kind of think of it as the stock's center of gravity. And that's important because this area could act as a really strong support level if the price were to pull back. Okay, so we've reviewed the basic evidence. Now it's time to bring in the specialists, the advanced technical indicators. But here's where our case gets, well, it gets complicated. It's kind of like interviewing a bunch of witnesses to an event, and they're all telling you completely different stories. And this right here is the core conflict of our entire investigation. The evidence locker is split right down the middle. On one side, you've got indicators suggesting that this upward momentum is strong and it could very well keep going. But on the other side, you have a pile of evidence that is just screaming that the stock has gone up way too far, way too fast, and is due for a fall. So let's hear the bullish case first. The stochastic oscillator, which basically measures where a stock closes relative to its recent price range, is pointing up. That's a good sign. The MACD histogram, a tool that's great for spotting trend changes, has turned positive, hinting that a powerful buy signal could be forming. And, well, the momentum indicator is positive, which confirms the strength of this recent surge. All of this testimony points to one conclusion: more gains could be ahead. But then the other witnesses take the stand, and they are urging caution. The Relative Strength Index, or RSI, is sitting at 73, and pretty much anything over 70 is considered overbought. The price is also trading above its upper Bollinger Band, which kind of acts like a channel for normal price action, and that's a classic signal that things have gotten too hot. To top it off, the Commodity Channel Index is at a sky-high 441. These are all flashing red warning lights on the dashboard, suggesting the engine is seriously overheating and a cool down is probably coming. So what do you do when you have such a clear conflict in the evidence? Well, to solve it, we need to step back from the tiny details and start looking at the big picture. How does all this recent frantic activity fit into the stock's longer-term story? The conflict really boils down to this simple idea: the short-term story versus the long-term story. Is all this recent excitement a sign that things have fundamentally changed for the better, or is it just a temporary blip in an otherwise established and maybe not so great trend? This table, wow, it makes the conflict crystal clear. The current price of 63 cents is way above its short-term 20-day average and its medium-term 50-day average. Okay, that's a clear sign of recent strength. But then you look at the long-term 200-day average, it's over $1. The current price is still significantly below its long-term trend, which tells us that despite this awesome recent rally, the bigger picture still looks pretty weak. Another great tool we can use to find that long-term trend is something called linear regression. You can think of it like a statistical detective that draws one single straight line through all the chaotic price movements to find the most likely historical path, the true underlying trend of the stock. And here is maybe the most stunning piece of evidence in this whole case. According to that long-term trend line, FGMY's price is currently trading 148% higher than where its own history suggests it should be. This tells us the recent price spike isn't just unusual, it is an extreme statistical outlier. Okay, we have examined the evidence from pretty much every angle. We've got the high volume, the conflicting indicators, and this huge disconnect between the short-term and long-term pictures. So, what's the verdict? Well, based on our whole investigation, there are really 3 plausible scenarios for what could happen next. So let's break down these 3 potential futures. First, you have the bullish scenario. In this version, that powerful momentum just wins out, it smashes through the current ceiling and pushes even higher. Then there's the bearish scenario, where those overbought warning signs prove to be correct, traders start taking profits off the table, and the price pulls back. And finally, the neutral scenario, where the bulls and bears just fight to a standstill and the price trades sideways while the market tries to figure out what to do next. So how do you know which scenario is actually playing out? You have to watch these key levels. They're like signposts on the road. A solid break above 63 cents could signal the bullish breakout is really happening, but a drop into that 55 to 60 cent range would pretty much confirm a bearish pullback is underway. These are the numbers that will tell us which side is winning the argument. So, given all of this conflicting testimony, the final conclusion from the source report is one of real caution. The official signal is a neutral hold. The evidence is simply too contradictory, too mixed, to confidently make a bet on the price going either up or down from here. The jury, for now, is still out. And that leaves us with one final, and I think fascinating question. In an investigation like this one, with so many signals pointing in completely opposite directions, what piece of evidence do you choose to trust the most? Do you trust the explosive, exciting short-term momentum? Or do you trust the heavyweight of long-term historical data? That's the challenge and the fun at the heart of cracking the code on any stock.